Hey, thanks for having me. I think to some extent, some of these large internet companies are increasingly being viewed as defensive names heading into a downturn, heading into a recession, whatever you call it, in the next, call it 3, 6, 9 months. And more importantly, these companies are looking at how they can reduce their cost structure in a way that is more durable. These companies overhired during 21 and 22. They hired almost doubled in some cases. Facebook and Amazon in particular doubled their footprint as far as employees, and now they're turning into skinny cats. So they obviously have really solid tailwinds with regards to revenues. But now that their Amazon has laid off almost 30,000 people, of I believe of 300,000 corporate employees. So that's about 10%. Facebook has laid off more than 20,000 people. That's almost 25% of their employees. So these are sizable cuts for these companies, and that should help them return back to profitability as we head into the recession. So that's why I like these names. They are more defensive
Return
in
back to
nature.
profitability versus sustaining profitability, Rohit, are two separate issues, right?
Yep. Totally. I think as the revenues are softer and probably might get even more softer over the next 6 months, I think these companies are jumping up ahead that, okay, we need to cut costs here. We need to make sure that the profitability doesn't take a very big hit as revenues might get hit. So I think that kind of helps them with shoring up their earnings in a way that some of the smaller companies may not be able to right now.
But I think my larger question, the larger point I was trying to make is that the hit that these stocks witnessed last year on growth concerns, those concerns are still very much around.
Yep, I totally agree. As in, the growth is not coming back anytime soon. On top of that, we have interest rates and discount rates at multi-generational highs. So the value that people are going to put on growth is that going to be that much at a premium. So what these companies are focused on is, okay, let's figure out a way to accelerate some of the profitability that we would have otherwise had in higher growth rate environments. Now, growth is not coming back anytime soon, perhaps in 24, hopefully. So why don't we get to a point where we pull in some of the profitability? So layoffs, lack of any new capital investments, that all those things are going to help with shoring up earnings. And I think that should help with stock price and sentiment as we head into kind of Q2 and Q3 of this year.